So how about we start now?
Perfect.
Okay, welcome to
Like,
our webinar. My name is Tatiana Gaspar and I'm the Managing Director of the Latin American Chamber of Commerce in Switzerland. We have currently some 37 participants logged on of over 116 who are registered. Let's hope everybody who intended to join can do it in the course of the next couple of minutes. Thank you all for being with us today. I want to extend a warm welcome to our guest speaker, Esteban Polidura. Unfortunately, at the moment you cannot see him. We are trying to make this video work, but for the moment, this is a technical problem we cannot master yet. But a warm welcome to you, Esteban. You have 23 years of expertise in finance. You are the head of advisory and products in the Americas at Julius. And thank you very much for agreeing to speak to our audience today. The topics you chose are spot on and highly relevant at these times of transition and uncertainty. I'm sure everyone is as anxious as I am to hear about the economic outlook you can paint for us, especially the perspectives for Latin America, and what investment advice Julius can give us here. Before we start, just a few words on the webinar itself. The session is being recorded, that works. And we are planning to put the recording on our website later at everybody's disposal. After the official session, which will last for about 40 minutes, we will have time for Q&A. If you have a question you want to ask, please write it in the chat so that we can pick it up. Now we are all ears, and I'd say, Esteban, the floor is yours.
perfect. Thank you very much, Tatiana. And I think, let's be frank, I think today is the lucky day of all our participants. Not having me in front of you is something good. I can tell you that. A pity for me because I took a shower and I dressed appropriately, but for the rest, the lucky day. So sorry about that, and we'll make the best of this. I'm sure you won't even notice that small detail. So yes, as Tatiana said, the purpose of today's gathering is basically to touch on three topics: the world economy post the COVID-19, our perspectives for Latin America, and finally, of course, how to invest in the current scenario. I'll go briefly through each of these topics, and I'll make sure to reinforce the key takeaways that I want to for you to take with you today. So let's start with the first topic: the world economy post COVID-19. I think here the key takeaways that are important for you to write down are mainly three. The current crisis is really due to an external shock and not systemic risk like in past crises. Second, massive policy response should work its magic, I would say, gradually and more toward the end of the year. And finally, the recovery should be evident in the second half of the year, but not at the same speed for all of the economies in the world. So let's start. And here I think this is critical to start with. This crisis is not similar to the ones we have seen in the past. Therefore, I would recommend to everybody not to spend a lot of time analyzing what happened in 2008, in 2000, in the Great Depression. Don't spend time doing that because the reasons behind those crises are very different to the reasons we are seeing today. And basically, and this you can go even to the 1600s with a tulip bubble. The main reasons behind crises in the past have been three. First, there has been a great deal of financial liberation. Basically, lots of credits granted to people that shouldn't have received that money, or in a very a quick way without the proper analysis. Second, speculation, and especially speculation toward the end of the cycle. And finally, an asset that was the center of investors' interest and of that speculation. So you can remember in 2008, it was the real estate sector. In 2000, it was the dot-com bubble. And we can find practically in each and every crisis in the past, these three ingredients. But this time you probably won't find them, and you won't find them because in the past crises were the result of systemic risk. This time, the crisis we are living in is the result of an external shock created by us, created to contain the spread of the coronavirus, but not the result of again of things that were not working properly in the system. Now, having said this, it doesn't mean that the crisis today should be easier than crises in the past. Not at all. Actually, this crisis is sharper and deeper than that in 2008. Just to give you a hint here, more than 5 trillion US dollars were erased in a matter of 3 or 4 months from economic growth this year because of the measures taken. 5 trillion dollars. This is roughly the size of the economy in Latin America. Not only that, but again, from 1 month to the other, you have been seeing a huge jump in unemployment, and we haven't really seen the last of it. We are starting to see double-digit rates across the board, and the risk here is that this can get only worse. Now, so far, the negative data has been centered in services. Manufacturing is slowly catching up, and this is because manufacturing was not as fast as the service sector to react to the containment measures. So in services, from one day to another, hotels had to close, restaurants had to close. There were no more flights taking place. But on the contrary, in the industry, you still had some companies operating, and some of them were actually considered essential activities and still are in some countries. So they keep operating. But as long as infection rates don't start coming down clearly and materially, there is risk for the manufacturing sector to see a similar path as the services sector has been seeing. So again, even though services has been more affected than manufacturing, manufacturing needs to catch up, and we will see some worsening numbers in future months. Now, having said this, and going back to my initial idea about the external shock and why this crisis is different, as soon as we start to see some better numbers in terms of people getting infected, as soon as we start to see that, we will also start to see governments trying to go back to normality and lift some of these measures. It depends on a country by country basis how fast this will be handled. You already see lots of countries in Asia and especially in Europe trying to go back to normality. Even the US is trying to do that, but you also see some other countries, especially LATCAM, where infection rates are just going up. So with this in mind, we expect China to be one of the first to experience a rebound in economic data. We actually see China going back into positive territory already during the fourth quarter of this year. For the US, we should see that more towards the third quarter of next year. And in the Eurozone, this is probably more a story for 2022. Now, which elements are playing in favor of this bounce back? Basically two. First, the speed at which the governments reacted to the pandemic. We all of us have seen and heard and read so much about coronavirus that we are all experts. But you can remember initially that China was very quick to react with very harsh measures. So it seems, and it's evident, that the quicker the reaction and the harsher the measures at the beginning, the faster the recovery that we will see. So the speed of reaction, first ingredient, and second ingredient, all the stimuli that we have seen across the board. Just for you to get a sense of this, worldwide, we have seen more than $8 trillion in stimuli. This is equivalent to 10% of global GDP. But of course, it depends on a country by country basis. There are countries where the stimulus is equivalent to 20–30% of GDP. There are others that barely get to 3 to 4%. So the combination of both will play in favor. And at some point, there is even the possibility in some countries of overstimulating the economy. We don't know. We don't know if this is going to be the case. What we know right now is that the amount of stimulus has been extraordinary, unprecedented, and that it will take some time for that to be evident in economic growth. But at some point, actually, as I pointed out, there is still the possibility of overstimulating the economies. Now, I promise I won't give you too many numbers in today's chat, because at the end that is typically a deal breaker for many of the attendees. But let me just give you some. And some, because these numbers can really show you what we are expecting, not only this year, but next year. Clearly, from what I said, we are expecting this year a tough situation that is reflected in our economic contraction forecast of 3.5% this year for the entire world. For the US, we are expecting 4.6% contraction, and in the Eurozone, a 7% contraction. I'll leave LATAM for the second part of our chat today. So with these three, you can see we are indeed expecting a very tough year. But next year, the story should be completely the opposite, and it should be completely the opposite because of what we were just discussing. So for next year, we are expecting the world economy to bounce back 7.5%, the US 5%, and the Eurozone 5.7%. So clearly, just with these data points that I shared with you today, you can clearly see that our expectation on a year-over-year basis is of a V-shaped recovery. Nowadays, you see all letters of the alphabet being discussed, L-shaped recovery, W-shaped recovery. Well, for us, it will be the typical V-shaped recovery that we will see on a year-over-year basis. So let's switch now into LATAM, because many of the things that I said are also things important to LATAM. So for LATAM, I think the key takeaways that are important for you to keep in mind are first to be cautious, because the stories across the board are tough. It's not only one country, they are tough across the board. Second, the drag of a global recession is intensified by prevailing low oil prices. And still today, a very restricted demand for commodities. And finally, local politics can also play against investors' confidence and will most likely play against investors' confidence in the near term. So for Latin America, let me now start with the numbers. For Latin America, we are expecting a 4.7% contraction in terms of GDP this year, and then a bounce back next year of 4.4%. Clearly here, the dominating stories are Brazil and Mexico for this number, but I will, of course, also speak about Argentina, Chile, Colombia, just to get a sense of the overall region. So let's start with Argentina. And while I'm discussing all these stories, just make sure you notice that a lot of the things that I will mention fall into the category of sensitivity to the global recession, or the impact of lower oil and commodity prices, or let's say domestic noise generated by politics mainly. So let's start with Argentina. Extremely tough story. Most of the rating agencies have downgraded Argentina to selective default mainly, and this was really a process we saw intensified after the country proposed to both the investors holding bonds issued under the domestic law, and now investors holding bonds issued under foreign laws. All these proposals that really mean a lot of money being lost, haircuts both on the absolute value of the bonds, on the interest front of 50-60%, and clearly this is something that not only the rating agencies didn't like, but also major creditors didn't like. So right now, Argentina is basically this week hoping to hear back from creditors if they accept the refinancing offer or not. Most likely no, at least from what we have been able to see in the last couple of days, and that of course increases the likelihood of a default. So that is the main issue that is right now in investors' minds. One thing that people don't talk a lot about, but that it's worth mentioning in today's conversation, is also, and this has to do with initiatives that have appeared lately, especially to increase taxes and taxes on wealth. This, of course, new taxes and sudden taxes, and there was even at some point the proposal to have taxes enforced on people that repatriated capital following amnesty programs in the past. All of these measures at the end affect investors' confidence. So it's not only the story around the credit and the defaults and the renegotiation. It's also the story about investors' confidence that I think is worth taking into account. And finally, over the last couple of weeks, Argentina hinted that it was ready to exit Mercosur, or at least not participate in ongoing negotiations. That, of course, would have been a very relevant news if it had not been for the president and some of his staff who later said that Argentina was not thinking of exiting Mercosur. but I think this is worth highlighting because with Mercosur, the problem is not only, let's say, the time that needs to be spent with the bloc in negotiating deals, but there seems to be also a relationship that between Alberto Fernandez and Jair Bolsonaro, that's not the best. So this is something that we need to follow, because if at some point that relationship really prompts Argentina to leave Mercosur, there will be an impact not only to the entire region, but especially to Brazil, Uruguay, and Paraguay, and most definitely also for Bolsonaro, who has been appearing as the leading figure behind this bloc. Let's switch now to Brazil. We are speaking a lot about Bolsonaro, so let's speak now about Brazil. Here, of course, the most sensitive topic is again related to Bolsonaro. It finds its roots on the way the government has reacted to the pandemic, very slowly. Not enough testing taking place. There is lack of confidence behind the numbers that are being reported. We saw a huge spike in infections and unfortunately in deaths over the last couple of days. Actually, between Sunday and Saturday, there was a 5% increase in the number of infections and a 4% increase in the number of deaths. So this is something that is really generating a lot of concern, not only between Brazilians, but also abroad. And therefore, Bolsonaro's reaction hasn't been the best. So now the risk of an impeachment is not a tail risk anymore. And I think this is something that we need to account for, because if Bolsonaro starts losing people's support and starts losing at some point support from the Congress, his reaction is something that needs to be seen. But we cannot rule out that in order to gain back that support, some of the policies on the fiscal front start to be relaxed, and that's something that investors wouldn't like to see. Now, to complicate things even further, you've had also the exit of key government officials in the last few weeks. Not only that, but some of them have left their posts, let's say, screaming and shouting and speaking in not the best way in terms of Bolsonaro and his administration. But let's leave that aside. The real problem is that now many people believe the potential exit of Minister of Economy Paulo Guedes is not unlikely, and that actually it is likely. There seems to be a lot of differences between Bolsonaro and him. We saw Guedes presenting an infrastructure plan yesterday that is an alternative to the infrastructure plan presented by Bolsonaro last month. So this is a story that we need again to follow, because Guedes is thought by the market to be in charge of the liberal economic agenda that people like. And if he were to leave, I would say you would see a lot of negative reactions across the board. So Brazil with a difficult story, because it's again not only the economic context, but also in this particular case the political noise. Now, if we jump to Chile, in Chile we are starting to see some of the economic data showing the impact of the current global scenario. unemployment above 8% in the first quarter, economic growth, or actually contraction of 3.5% last month, and the consensus expecting a GDP contraction in April to reach as much as 12%. So clearly a very tough situation, because here it's not only the global economic crisis, but also the high dependency on China, especially on the copper front, that is really affecting macro data right now. Fortunately, the government has been very active in launching stimuli programs across the board. Initially, the government program was of about $12 billion. Then it launched another one for another $5 billion. All in all, equivalent, both of them, to 7% of GDP. And that's the good news. Of course, the bad news is that money has to come from somewhere, and that somewhere means higher leverage. So I would say it shouldn't surprise us that the gross debt to GDP jumps from about 28% last year to 33-35% this year. And some of the, let's say, some of the room to maneuver is getting narrower. On the economic policy front, rates have reached a technical minimum of 0.5%. So going even lower seems difficult. But the government is starting to launch some alternatives, like bond purchases and granting credit lines to banks, and that alone should translate into about 17% of GDP of fresh money that banks can lend to reactivate the economy. So for Chile, not entirely a bad story, but one where economic metrics are deteriorating fast. Colombia, a story very, very dependent on oil prices. The government rating has been downgraded, and the outlook has been downgraded. So now the sovereign is barely above investment grade. Unemployment keeps rising. Right now it is at about 11%. And as I said, here the weakness comes also from oil prices. Keep in mind that oil represents about 40% of total exports, and it's not only let's say on the GDP front that oils have an impact. Here, an environment of such heightened risks also translates into money flowing out of the Colombian peso, which then translates into depreciation, and that at the end is inflationary. So Colombia with a difficult story again. And finally, Mexico. Here also the sovereign rating has been downgraded. It is still investment grade, but the problem here is that Pemex, which has been downgraded to speculative by a couple of the major rating agencies, is the most indebted oil company in the world. And the federal government is thought to be a last source of support for Pemex, and should be. So at the end, both stories are very, very linked together. I was mentioning the debt of Pemex, and here I think, again, some numbers might shed some light about how difficult the situation is. Pemex, in terms of financial debt, it holds about $110 billion of financial debt. But apart from that, it also holds about $75–80 billion in in debt tied to its workers, pension liabilities mainly. All in all, they amount to about $200 billion, which translates into roughly 15% of Mexico's GDP. So and the message here is I would be very, very cautious with both the sovereign rating and Pemex's rating, because the current global context, along with the prevailing low oil prices, can really have an impact on not only the ratings, the ratings, but also on investors' confidence. Because here again, if the government at the end is going to help Pemex in a very stressed situation, the government will have to find ways to come up with that cash. And that again is not straightforward. Well, where will that cash come from? More leverage, the foreign reserves, that has to be clarified. Lastly, in terms of Mexico, the response in terms of the coronavirus has been slow. The government believes this week should be the one that depicts the worst numbers, but as you know, nothing is written in stone, and we still need to see what the impact will be. So before I go to our investment ideas, I just want to end this economic analysis with more of a long-term thought. No, here, all of these countries that we have discussed, whether it is the US, the Eurozone, LATCAM, all of those countries are eager to lift let's say the blockings to go back to normality, and with that to restart their economies. But the question here is, what will be normality under the current situation? Will it be the way we lived in the past, or will it be something completely new? What I can tell you is that at least in our view, we will see clearly three different things. And let's start with the economic side of the story. On the economic side, there is no other way than implementing what we know as modern monetary theory, basically using the government's and the central bank's ability to influence rates with fiscal incentives to boost economic growth. The problem here is that state-dominated economies, in a time where globalization is losing some ground, might not be the best idea, because at the end, this could translate into loss of productivity and also a lower wealth creation across the board. Now, on the political front, the current situation also fosters the appearance of some authoritarian leaderships, people that appear and tell everybody that they will take control of the countries. And that, again, not the best idea in terms of surprises and volatility, because with that in mind, I think the market needs to be mindful that that political noise is here to stay. And finally, on the social front, I think the current situation has shown very, very clearly inequality all over the world, and therefore the fight for a more equal society is going to be a key and hot topic in practically all of the countries that you can think of. So you should expect more of these movements that we have seen lately taking place, because the current situation has just shown that the world is very, very unequal. Now let's go to our investment ideas. I promise I will end in about 5 minutes or so. Here I want you to take 3 core conclusions with you. First, I think you should set yourself and your portfolio for an economic rebound in the second half of the year, and very clearly next year, as I said at the beginning of our conversation. Second, China should lead that recovery, and not only because of that, but because of many other reasons. China should be an asset class of its own and should be included in your portfolios. And finally, remember to include secular themes in your investments. For example, healthcare, sustainability, etc., because those stories tend to have different correlations to the traditional assets and therefore provide diversification benefits to the portfolio. So how to structure a portfolio in current times? Well, we would still have a rather defensive portfolio, and that means maybe an even split between equities and bonds, but also a space for alternative investments. By that, I mean private equity, private debt, gold, for example, and also some space for cash, so that you can take advantage of opportunities that these markets are going to allow for. In equities, what we like are basically China, as I said, but also globally we like the IT sector. We also like the healthcare sector, and we like, for example, financials. In fixed income, we like emerging markets, but emerging markets, think of emerging markets in hard currency, basically in US dollars. So if you were to invest in bonds in emerging markets, just make sure these are US dollar denominated bonds, because for the time being, we don't see a scenario where the US dollar will lose strength materially against of the emerging market currencies. On the contrary, as long as volatility remains high, as long as the uncertainty remains high, the US dollar should be a safe haven currency. So in fixed income, emerging market bonds in US dollars and some high yield bonds are worth having in portfolios. And just to conclude, in terms of currencies, I already told you a little bit. With the US dollar probably remaining strong the next 3 to 6 months, I think it doesn't make sense for you to have very aggressive bets on some currencies gaining ground against the US dollar, especially Latin American currencies. I would be particularly cautious to take aggressive positions on the Mexican peso. And the reason for this is that the Mexican peso is by far the most liquid currency in Latin America. So it is used by investors and especially by speculators to place bets against events all over the world that maybe don't have to do with Mexico at all. So, and I get a lot this question from investors. And here I always try to reinforce that most of the movements that you see for the Mexican peso are really linked to events happening all over the world and not to domestic issues. So be careful. You might have a very positive outlook for Mexico, but the peso could suffer because of speculators using it to, here I'm thinking out loud, to place a bet against Argentina or to place a bet against Brazil, or to place a bet against the US-China relationship. Who knows? Just be careful about that, and treat emerging market currencies and Latin American currencies especially with caution. So US dollar for the time being, a currency that we believe should remain strong. To conclude, on the global front, again, we haven't seen the worst. Be careful. Second quarter numbers will be horrible, especially for some of the economies, even though many are already expecting very poor numbers. I think that and clearly this is related to the lack of visibility. The surprises could be very negative. So be careful. LATAM, a difficult story because it is not only the global context that's affecting the economic story of the region, but you also have the links to oil and commodities, and you have especially political noise taking place in most of the countries in the region. Finally, on your portfolio perspective, remain calm. As I said, try to align your portfolio to a weight between equities and fixed income and cash, to weights that are aligned to your risk profile, and then use the volatility that we are seeing to try to tap into some opportunities, but don't make the mistake of trying to get in everything that seems to be cheap, because in current times and in volatile times, what we have seen is that in most cases, what appears to be cheap has a strong reason to have depressed valuations. So focus on the high quality business models. Even though valuations might not be the lowest out there, it is better to pay for quality than to go into the cheapest names in the market. So with that in mind, Tatiana, I'm ready to answer any questions that we may have.
Yes, well, thank you very much, Esteban. This was highly interested, quite a firework of a session. Very valuable, diversified, and well-structured input. You promised me this morning it would be fun, and in a way it was, although we are speaking of a very serious topic with a rather tragic outcomes for many people in this world, but nevertheless, thank you very much. And we have indeed some questions. I will go by first come, first serve. There is a question from Christian from Mexico, I believe, Christian Michel. Does entry into force of the USMCA and finalization of the Mexico-EU free trade agreement will boost the Mexican economy post-COVID-19?
Sure. It is definitely a positive, but I don't want people to get the sense that it is going to change the story dramatically. And this is because between NAFTA and USMCA, the trading activity between the US and Mexico did not really slow down. So it is clearly a positive that we have left that noise behind us. It is even more positive that some additional clauses have been embedded in the trade agreement, that it was modernized. But I don't expect, and this is also the case a little bit with the trade agreement with Europe, I don't expect to see a sudden jump in trading activity just because the new, let's say, the new documents start to be operational. As I said, trading activity has remained as high as possible, and I say as possible because the current environment has not allowed better interaction. But I would say don't expect something materially different, at least not within the next 12 months, because those 12 months will be very, very sensitive to the speed at which the US, especially the US, can bounce back from this situation.
Okay, then we go to the next question from Maria Muli. How does this situation will push the digital transformation in the consumer behavior?
Sure. Actually, thanks for mentioning it. Digital, everything that has the word digital is a topic that we like. On the consumer front, we have seen a huge spike, of course, during current times in e-commerce. I don't have to tell you about this. Probably you, like me and my family, have lived the last 5-6 weeks from ordering stuff from Amazon and some other e-commerce sites. And what's interesting here is that the digitalization trend was something that we were already seeing, but the current situation just shed more light on the benefits of that digitalization. So e-commerce has improved, can only improve, but take a look also at other stories around digitalization that should only accelerate growth going forward. One of them has to do with digital ways of paying, basically debit cards, credit cards. Cash is losing ground that all these digital payment methods are gaining. So another way to play digitalization is not only through e-commerce sites, but also through all these digital payment options that are out there. And finally, I don't have to say this, everything that has to do with streaming, video, music, video games can only grow faster. And this is because two things. First, the social distancing measures that we have seen in the last few months have really shown that we don't need to leave home to have a good time. This is something that maybe before we didn't see that clearly, but now we have experienced this and we have already seen this. But going forward, I would say that some of these social distancing measures probably are here to stay. And therefore, streaming is most likely going to get even more popular. So digitalization, a great theme to invest in, and especially in many different ways.
Okay, thank you. We now have the next question from Philip Nell. During the 2008-9 financial crisis, European countries had, as now, to run very large budget deficits. This led to the debt and euro crisis of 2011-13, Italy, Spain, Portugal, Ireland. How do you assess the risk of a similar scenario by 2021 or 2022? How will these and other countries be able to meet their public debt payments?
Yeah, great question. I'll start by saying nothing should be ruled out. And this is because, again, the current crisis is unprecedented. You know, the impact that it has had on the economies, the speed at which things have deteriorated, the amount of people that have been laid off, and on the other front, the incredible amount of money that has been compromised in different stimuli programs. All of that all of that have never been seen. So how they will, imagine you put all of that into a blender, the end result is definitely unknown. But on the positive side, I would have to say that for many countries, leverage is not as high as you have seen in the past and in past crises. One. Second, there is still room for rates to come down, even to get even more negative. And that again, simply to say, don't rule out a monetary policy in Europe. Things can still be enforced on that front, especially on the quantitative easing front. And finally, this is key. In contrast to 2008, today, with rates so low, so low for most European countries, let's say practically zero, it is very cheap for governments to finance themselves. So that means they can go and do some concessions on the fiscal front, basically cut taxes, and still find ways to get money with the market at attractive and very low rates. This is something that didn't exist in the past. So to conclude my answer, I would say the likelihood is low because of the tools that governments still have, especially the potential of financing themselves at very low rates. But again, this external shock that we are living in, and all the negatives and positive things that arise from it, simply tell us that uncertainty is very high. So we need to remain humble in terms of having very, very optimistic opinions right now.
Thank you. I go on with the next question from Sheila Ferreira Pinto. Thank you for the analysis. I take the opportunity to ask, do you believe in products and services joining companies in a hybrid contract? In the insurance market, for example, a dental product with a life product among specialist companies?
Sure. Yes, I think today's situation is really one where we need to put our heads together to try to extract as much synergies as possible from whatever already exists, and combining products is a very interesting way to do that. I would take here the opportunity to speak, for example, about structured products. Structured products are thought to be by many something very risky, something that only experts should look at. But in reality, structured products allow you to take a position, whether you are looking to benefit from markets going up or markets going down. They allow you to take a position, and at the same time, they allow you to limit your downside to have a specific payoff. So, and this is done, of course, by combining different things. You combine stocks with a derivative, you combine an index with an option. Anyway, I think indeed combining products in the financial sector going forward will be ever more important. And in reality, we are seeing that at least in the financial sector, some of them, different types of structured products, are proving valuable in allowing investors to have exposure to certain stories, while at the same time limiting and capping potential losses.
Okay, let's take the next question from Juan Carlos Gonzalez. What is the currency exchange for Mexico at the end of 2020?
Sure. Great question because of a couple of things. First, our forecast is for the next 12 months, if that is useful, 22 pesos with 50 cents. Having said this, take any currency estimate that you hear for Mexican peso, especially from us or from any other analyst, with a grain of salt. And this is because, again, that huge ingredient of speculation that the Mexican peso is sometimes subject to pushes it to trade, in many cases, far away from its fair value. So to give you an idea here, the fair value for the Mexican peso, and I mean fair value, trying to get to a valuation on 2, 3, or 4 fundamental valuation techniques. The fair value of the Mexican peso over the last couple of years has been between 18 and 19 pesos per dollar. You have seen it trading closer to 18. You have seen it trading closer to 25. And that only shows you that that speculative ingredient, which cannot be forecasted, plays a major role in the path that the peso follows. So even though our estimate for the next 12 months is 22.50, just remember that the likelihood of abrupt movements and of the end result to be different from our forecast is very high because of that speculative ingredient.
Okay, just to let you know, we still have a lot of questions, so brace yourself, dear Esteban.
Very good.
The next one is from Kami Shetela. What is the current economic situation of lower middle income countries such as Bolivia and Paraguay?
Even more difficult. You have, in those particular cases, several things combining to make a combination of stories that at the end plays against the prospects of those countries. So, and I would also add here a difficult story such as Ecuador. So here you have first countries where the economy is extremely tied to a certain commodity. So these are typically not countries that are hugely industrialized or with lots of trading agreements. No, these are countries that are especially dependent on 1 or 2 commodities. These commodities find typically a market in Asia. And again, today, Asia means China. And as soon as China doesn't really show a clear recovery, demand for those commodities will be subdued. And again, keep in mind that the story in China is not particularly straightforward. Now, President Trump has brought back these trade tensions. So again, demand for commodities can take a while to recover. That's one. Second, these are countries where government finances are typically weak. They don't have huge foreign reserves. They don't have central banks that have a grip on inflation. So these are economies that are very sensitive to whatever happens abroad. I was mentioning the story of Argentina and Mercosur, where if really Argentina were to leave Mercosur, Paraguay would be one of those stories that would suffer materially because they are very, very linked to that trading activity in the Mercosur bloc. So to finalize my answer, I would just say if for countries with a diversified revenue stream with strong or pretty strong government finances with links and trading links to many countries in the world, if for those countries the current situation is tough, now imagine for smaller economies where a couple of commodities can really mean the difference. I would be very cautious on those countries.
Okay, the next question is from Adam Baha. As you said during your presentation, some Latin American countries, such as Peru and Chile, are heavily suffering in the current crisis due to their strong ties to the Chinese economy. Will this logic apply in the opposite way? In other words, will they see a faster and stronger rebound as China will be the first ones to rebound?
They should, indeed they should. And that's a great question because the story for both Chile and Peru, even though it might be different, for one, you have copper as the main commodity linked to China. For Peru, you have other, for both you have agriculture also exposed to China. Indeed, a China recovery should be a major tailwind for both stories. What I would be cautious about is basically on the domestic front that politics and the social stability or instability don't offset completely the positive impact that a China recovery could have on investor sentiment. And here, probably Chile is more at risk than Peru. Peru has had its deal of political noise last year, but for already quite some months, politics have stabilized. But in Chile, you probably remember well that the public demonstrations were very, very intense right before the coronavirus hit not only Chile, but the world. And therefore, all these social distancing measures and lockdown measures really have quieted down that claim for a better social situation. So I wouldn't rule out that once infections start to normalize and Chile starts to go back to normality, lifting the lockdown, you see a rebound of that social instability, especially because remember, Chile is set to have a referendum to discuss and approve a completely new constitution toward year-end. So because of that and many other social topics, I think we should be careful that a pickup in China doesn't really get diluted due to the political situation in Chile and again for some other countries likewise.
Thank you. Now the next question is from Paula Villatores. What impact in international trade will Latin American economies experience?
Sure. The story the question is very interesting because it's going to be very different for many of the countries in the region. And this is a typical mistake that some investors do, to think of Latin America as a homogeneous region, such as, let's say, Europe could be. In Latin America, you have very, very different stories. So in terms of international trade, really the most exposed stories are Mexico, followed by Brazil. That's it. Then most of the other countries are really commodity oriented, and even Brazil is very domestically oriented. So the really sensitive story is Mexico. Mexico exports close to 85% to the US. So it is a story that's heavily dependent on the speed at which the US recovers from this situation. I would say that right now we believe, again, the US is still far from seeing the worst of the pandemic, and that therefore going back to positive economic growth, as I said at the beginning, is more of a third quarter of 2021 story. But Mexico needs to be mindful of that. So assuming that international trade for Mexico won't see a difficult time the next 6 to 12 months is probably not the right way to see that story. So on international trade, Mexico is the sensitive story, and it will all depend on how fast the US economy can recover. Having said this, the US has announced more than $2 trillion of stimuli. So there could be positive surprises, but Mexico is very dependent on how fast that recovery plays out.
Okay, thank you. Then one question from Linda Walker. Who might be the new president of the IDB?
Great question. I have absolutely no idea. I have no idea, to be honest, because there are still some options that are out there, but that's something that we should also follow, because it's not only in, let's say, in some of the main global agencies where you will see a change of leadership. You have also important elections taking place for several countries, and I don't need to say this, but November in the US, a critical point in time, and both elections for agencies and elections for governments are important, because attracting, let's say, the votes and the liking of people that get to vote can really imply different strategies, and some of them strategies that can generate volatility. So, for example, going back to the US, as soon as November's elections start to approach, we will see probably President Trump taking a different stance, taking different actions to attract those votes, and at some point that again can generate volatility. So all of those stories, we will make sure to follow them closely and just be mindful that they have the potential of generating volatility in the market.
Okay, we have one more question from Eduardo Mendoza. Will you please give us a few comments about Venezuela?
Yes, well, as far as Julius Baer has to do, we don't have active research on Venezuela, so there, unfortunately, I cannot share a rating or a clear recommendation. This is a story that I would suggest to take very cautiously, most likely to remain out of it, because it is completely tied to politics, to a regime that we cannot clearly see where some of the decisions will take not only the economy but the fate of the people. Venezuela is living an extremely sensitive situation. because of its high dependency on oil, and of course a prevailing scenario of low oil prices is very damaging to the economy, and this is something that we really see. We see oil prices probably approaching 30, 35, or remaining around 30, 35 around summer, approaching $40 per barrel toward year end. But look, I'm not speaking about 80, 70, $80 per barrel. I'm speaking about 30, $40 per barrel, which is roughly where we have been in the past. And the risk here is for prices to be materially weaker than that. And this is because the capacity around the world to storage oil is reaching very rapidly a limit. And many people think, and with that, of course, prices are extremely weak. Many people believe that because of the recent supply cuts that have been agreed between OPEC and OPEC countries and Russia, we should assume that supply should not be an issue anymore, and that therefore storage capacity will not be a problem, and that consequently prices will start going up. The reality of that is that this cannot be the case. This might not be the case. First of all, we have seen in the past that OPEC agreements are not followed 100%. So even though right now there is an agreement to cut 10 million barrels per day, we might actually see 5 or 6 taking place. That alone is negative to oil prices. And then, of course, if oil production remains high, then the likelihood of reaching a limit of storage capacity worldwide is also plausible. And imagine how extreme the situation in the oil sector is, that we already saw negative oil prices, basically someone paying someone else to take the barrels off their hands. So to go back to the Venezuela story, the problem here is that with an economy so dependent on oil and on oil prices, and with the oil price scenario going forward so potentially skewed to the downside, I would say the likelihood of Venezuela suffering even more than what we have seen is high. So be very cautious with that story.
All right, I believe we have one more question from Franz Kunz. What about investments in wellness and well-being for employees in Latin America? I see some foreign companies trying to launch or relaunch solutions for that segment on a very digital base. What is your opinion on that when it comes to Latin America as spending or investing money on that? Which impact will investments in the employees in the future after COVID-19 concerning investments have?
Yeah, great question. Unfortunately, wellness by itself is not very investable from the point of view of someone looking for stocks or bonds. You can clearly find opportunities on the private side, probably even private equity side, but on the liquid markets, wellness is too much of a narrow story to play. But what you could definitely play, which is very linked to the question and to the spirit of the question, is sustainable investing, and in particular all these stories that have a great deal of criteria related to environmental, social, and governance issues, the famous ESG criteria. So all of that is investable. As I said, ESG is part of the broader sustainable investing theme, and this is one of our preferred themes going forward. I was mentioning in the middle of my presentation about how to position the portfolio, which stories to include, and I said, make sure you include some long-term themes because they have a different way of behaving than the traditional asset classes and the traditional stocks and bonds that you buy. So clearly, sustainable investing, ESG, and wellness as part of that social criteria should have a place in a portfolio. What we have seen in this crisis is that all these social responsible investments have had superior results than the overall market, and that alone should push more and more investors to look for these potential stories that meet the ESG criteria, the sustainable investing criteria, to include those in their portfolios. So I think, again, it is a no-brainer. The business models tend to be sound. They provide diversification benefits to a portfolio because of their low correlation to traditional assets. And finally, given the inherent benefits of those business models, and especially because you can align your personal beliefs to the stories that you buy, the potential demand for sustainable investments and for ESG leading stories is set to increase. And again, thanks for the question, because it allows me to reinforce sustainable investing as one of our core themes going forward.
Very good. This was the last question on my list here. Thank you very much, Esteban. This has been truly very insightful. I got several comments from our participants today that you made an excellent presentation, very illustrative and reflecting about the great challenges in front of us. I would like to thank you very much from all of us here at LATCAM and from our participants for taking the time and for giving us a really insightful and holistic presentation, and also at the end a bit of reassurance in terms of investments that we can there do. And from my side, it was a pleasure to host this webinar with you, and thanks to all our participants for joining us today. My apologies again for not making the video of our speaker work properly. Hopefully next time we will be luckier. And I wish all of you a lot of resilience and good energy. Be safe and see you hopefully soon. Thanks. Bye-bye.
Thank you. Bye-bye.